Good afternoon. My name is Jim Diott. I am the Executive Director of the Master of Professional Accountancy program here at Rady School of Management. I am joined this afternoon by my dear friend and colleague, Professor Andrea Perez of our accounting group. Both Professor Perez and I welcome you to our annual Master of Professional Accountancy Capstone Conference. We have had the pleasure of working with these young colleagues throughout the year, watching them navigate their return to campus, learning from our amazing faculty and lecturers, and taking all of this and applying this knowledge and experiences through creating their capstone idea, their research, and today's presentations. This year's conference, we're focusing on helping boards create a blueprint for the challenges of today. Inflation, interest rates we haven't seen in decades, a regional conflict that has impacted the entire globe, and continued strain in supply chains from the pandemic are all top of the agenda for boards. Today, you will be hearing from our graduate degree candidates for the class of 2023. We strongly believe these colleagues have invested in themselves and are very much so committed to their careers in public accounting. We believe they are ready to enter our profession, and we look forward to the challenges and opportunities that you, our stakeholders, will provide them. Our students have learned much from our world-class faculty at Rady, learning how to apply this new knowledge to today's challenges. And with that has come the support of professionals such as you in our classrooms and those who have supported our capstone teams. We are very thankful for those speakers and advisors that have come from firms such as EY, KPMG, Moss Adams, Deloitte, RSM, SDG&E, Kimberly-Clark, DoorDash, Google, and Ackerman Law. The list continues to go on, and it's important because what you've done is, by engaging with our students this way, you've encouraged them to take on board-level challenges and providing them an opportunity to express what they think might be helpful. At this time, we suggest sitting back, closing out your other applications, putting on some high-quality headphones. Enjoy the presentation that's coming up. Our next panel is really one of my favorite topics. It's learning about the acquisition of companies that are under distress. This panel will provide guidance to boards that play a crucial role in mergers and acquisitions. We're going to take a little bit of the insights that have come from the SVB Citizens deal and focus on things that you might want to consider in acquiring a company under distress. I am delighted at this time to welcome to our virtual stage Ryan Kim, who will be facilitating this afternoon's conversation with his colleagues today. Ryan, the virtual stage and microphone are now yours.
Thank you, Jim. Hello, we are Team 5, and I'm the lead speaker, Ryan Kim. Today, we are here to explore the captivating story of First Citizen Bank's acquisition of Silicon Valley Bank, an acquisition that had a profound impact on the banking industry. This presentation will provide you with a comprehensive overview of this transformative journey, highlighting the process, outcomes, risks, and rewards involved. We will examine the strategic decision-making that led to the acquisition, the integration process, the synergistic potential, the lessons learned, and future perspectives. Through this exploration, we aim to offer a big picture view of the distressed acquisition and provide valuable guidelines for future potential distressed deals in the banking sector. Here is our agenda. First, what happened at Silicon Valley Bank, the deal with First Citizen Bank, overview of the board's role in M&A, and it continues. Here are our panels: Gregory, Ryan, Amy, Star, Nancy, and Michelle. Now, I'll hand it over to Michelle, and she'll be talking about what happened at Silicon Valley Bank.
Thank you, Ryan. Starting with what happened at SVB. In general, everyone knows that SVB failed almost overnight. The bank was shut down after its investment greatly decreased in value and its depositors withdraw large amount of money, among other factors. So here is a timeline that points out how fast it collapsed and what happened before the M&A. On March 8th and March 9th, the days before it fell, SVB sold more than 21 billion of securities, borrowed 15 billion, and would hold an emergency sale of some of its treasury stock to raise 2.25 billion. Despite the steps taken by the bank to avoid getting worse, Moody's, a company that delivers opinions on credit risk through its credit ratings, downgraded SVB. Along with warnings from prominent Silicon Valley investors, customers withdrew funds of 42 billion on March 9th, causing its stock to plummet 60%. On March 10th, SVB failed after a bank run. In the morning, the California Department of Financial Protection and Innovation seized SVB and placed it under the receivership of the FDIC. On March 12th, the first auction of Silicon Valley Bank assets was held and attracted a single bid from an unnamed company that was not a bank. The FDIC canceled the auction and scheduled a second to attract bids from major banks. In the meanwhile, the US government announced it would backstop all SVB deposits. On March 26, the FDIC announced that First Citizens Bank will acquire the commercial banking business of SVB. I'll further discuss the details of the deal in the later slides. So there are three causes of the collapse that I would like to point out. The first one is related to tech companies. SVB is deeply tied to the tech companies. At the end of 2022, the positive impact of the COVID-19 pandemic on science and technology had benefited SVB as its deposit increased. However, after we are in the post-pandemic era, tech companies struggled due to economic conditions. Thus, customers started to withdraw monies from the bank. The second one is credit ratings. As mentioned in the previous slide, Moody's downgraded SVB with its long-term local currency bank deposit rating downgraded to A1 from AA3 and its issuer rating cut to Baa1 from A3. This makes SVB seems unstable to its customers. Lastly, inflation and the Federal Reserve raised rates. As SVB loses its competitiveness as higher borrowing costs sap the momentum of tech stocks that had benefited SVB. There are four categories that I would like to talk about regarding the effects of the SVB collapse, and it is also worth mentioning that some of the impacts are also the reason why SVB collapsed. So the first one is startups. After the collapse, many startups were unable to retrieve money, resulting in companies taking out loans to make payroll. Some companies even reduced their workforce through layoffs or just shut down entirely. In addition, many of the world's leading technology companies relied on SVB for essential financial services such as lending, cash management, and investment banking. Therefore, one of the most immediate effects of the collapse of SVB is a disruption of financial services. Also, while the bank plays a critical role in financing many of the most innovative and high-growth companies in the sector, there are challenges for these companies to secure the financing they need to continue to innovate and grow. Additionally, the collapse affects the global economy and other countries around the world. As a leader in technology and finance, the United States has a loss of confidence in its ability to maintain its position. People may question its ability to maintain its global influence. So as we mentioned earlier, on March 26, First Citizens Bank acquired SVB. Not many know that First Citizens Bank acquired SVB through a government-backed deal to buy about 72 billion of SVB assets at a discount of 16.5 billion. Here are some of the details of the acquisition. Overall, the transaction between First Citizens Bank and FDIC is structured as a whole bank purchase and assumption agreement with loss share coverage. The deal involved acquiring total assets valued at 110.1 billion with a government-backed deal and total liability at 93.6 billion. To dig in a little bit deeper, as we can see from the chart on the right side, the acquired assets and liability consist of 72.1 billion in loans and 56.5 billion in deposits, and no investment securities acquired. So regarding things other than money, the bank also had the option to purchase all branches and corporate locations while committing to retain employees in the acquired revenue-producing businesses and those necessary to manage operations to support those businesses. And lastly, as part of the agreement, the FDIC received a value appreciation instrument worth up to 500 million from First Citizens Bank, which is payable in cash until April 14th, 2023. So beyond the details of the acquisition, acquiring troubled companies bring incredible opportunities and also the risks. First Citizens Bank may have downsides such as limit liquidity and credit risks. Therefore, it has structured 3 downside protection. Asset discount and loss share agreement with the FDIC, which help provide downside protection against credit risk. A 5-year loss share agreement stipulates that the FDIC will reimburse First Citizens Bank for 50% of losses on commercial loans for over 5 billion and a liquidity facility that was entered into with the FDIC to provide additional contingent funding if needed to both help provide downside protection against limit liquidity. Next, I'll pass it to Nancy, and she will be talking about the board's role in M&A.
Thank you, Michelle. We all know that acquiring firms need to take many factors into consideration to assess whether to execute the deal. To achieve the company's expectation on business acquisition and meet the anticipated interests of shareholders, the board's role is crucial during the M&A process. With professional experience and no financial incentives causing bias, the board is in the best position to engage in an oversight of the M&A process related to due diligence. In addition, according to McKinsey's report, an active involvement of board can help companies capture more value in deal making. A successful acquisition can help a company expand a lot faster in the market, while poorly executed transactions can cause serious damages to companies. Given the risks, it's important that the boards and management collaborate with each other to ensure the successful implementation of due diligence process. And I would like to discuss the board's duties in 3 different aspects: challenging value creation potential, creating a competitive advantage, and testing the PMI plan. As I mentioned earlier, the board is in the best position to assess the M&A strategy. So the board's responsibilities are to thoroughly scrutinize the strategy and reasonably challenge the management team. First, the board should make sure the M&A strategy is fit for a corporate strategy and help clarify the relationship between a potential transaction and corporate strategy. They can begin with questions such as, how will the deal support the company's growth? How will the deal create value for the firm? Secondly, the board should also test the assumptions of a deal, not just rely on those estimates. The board should adopt the DCF method to make a valuation of the firm post-integration and analyze the enterprise value affected by costs and synergies. Some boards will create 1 or several subcommittees to engage in more intense oversight of certain areas, depending on the scale of the transactions. Seeking outside financial experts to provide fairness opinion on the deal is another effective way. In addition, assessing whether the forecast growth rates and other estimates are consistent with industry norms can help reduce the risk of failure. Sometimes the analyses might not be able to underscore some risks or benefits of the deal. In this kind of situation, the board should state that it's fine to acknowledge those uncertainties in the estimation, because what matters is the management's ability to assess potential risks and rewards. The board should find the correlation among those types of risks and consider the impact that might have on the firm in the future. Moving on to the board's second role, which is creating a competitive advantage in M&A. While providing an oversight on corporate strategy, the board and management must reach consensus on the role that M&A plays in generating value for shareholders. Their communication about the sources of value must be very specific, and the board should understand and regularly review how those sources can fit in with the prospective deal pipeline. In addition to a sophisticated M&A strategy, the competence of leadership of senior executives can materially affect the creation of value. The board should guide senior executives to get a clearer picture about their roles of the corporate center and what an ideal scope of M&A looks like. During the M&A process, the board should also ensure that the decision made by company is well structured to counter risks in both early and final stages of the deal. The other duty of the board is to test the post-merger integration plan, the PMI plan proposed by management. I'll be focusing on the board's role to review PMI, while my colleague Amy will cover PMI with a focus on post-merger considerations and the business entity itself. So according to McKinsey, effective PMI plans can boost the net value creation for the acquiring company by almost 3 times the value compared to ineffective PMI plans. Therefore, the board should thoroughly scrutinize the PMI plan of a transaction. In terms of the leader of the PMI plan, it is important for the board to appoint senior integration managers who are well equipped with skills to realize the deal's value. Regarding the effectiveness of the PMI plan, the board has to confirm that they are able to launch the plan on the day of integration, or value leakage of the firm is very likely to occur. Again, since the M&A transaction can get extremely complex, it is emphasized that the board and management should work together, especially in the due diligence process. And next, Sarah will be introducing an overview of the due diligence process.
Thank you, Nancy. So the whole idea of the due diligence process is to basically answering the following question. Does the acquisition align with our company's objectives and strategies? Do we understand the reasons behind acquiring the company? And how can we gain a better understanding of the goals in relation to our organization? And can we trust the provided information and determine its fair value for our firm? Lastly, our goal after the acquisition is to ensure that the combination is not just efficient, but also profitable. And in doing so, we need to go into a due diligence process that normally, if everything goes well, will take 3 to 6 months with a talented team of advisors, including our accountants, investment bankers, attorneys, and internal team. However, in the case of a distressed company, time is limited. As Michelle mentioned, it takes less than 3 weeks in this SVB deal. Acquiring a distressed company involves substantial risks, but also potential upside. So it requires careful management to maximize the benefits. Now let's begin the process. The first step is the pre-due diligence. Obviously, that is not done in the SVB case. However, based on the previous acquisition First Citizen Bank had in January 2022, they merged with CIT Group, which was also a distressed company. So they can accelerate based on this previous acquisition and should be comfortable with what they look for. The next stage is the letter of intent. It demonstrates the serious interest and opens up the door for information exchange. And then we need to go through the procedure of the due diligence process, like the plan and identify the areas that need to be reviewed and set a timeline, which is very short in this case, and to gain access to the company and its people, to gain access to the information that is beyond what they publicly filed. And then we need to examine all the areas of interest, including financial statements, legal compliance, and operations. In this case, it is certainly a very difficult situation to perform a comprehensive analysis and have a thorough report. Throughout the negotiation process leading up to the final deal closure, a great team is crucial, especially for a distressed situation. The expertise, the experience, and collaborative efforts of a capable team are essential for navigating complex situations like this, ultimately to achieve a successful outcome under a short amount of time. Certainly, there are limitations during the due diligence process. There are confidentiality concerns, lack of cooperation from the company, and the information provided might be inaccurate or incomplete. It will be expensive and time-consuming. As we mentioned, it normally takes 3 to 6 months for a comprehensive due diligence review, and there may be a lack of expertise and experience in the team to deal with a distressed situation. Lastly, we have limited ability to predict the future, as the due diligence only evaluate the historical data and the current stage of the company. And there are more limitations regarding this acquisition. It can be challenging to obtain a complete understanding of SVB's liabilities. And due to the time constraints and limited information, it can be difficult to assess the true value of SVB's assets. The First Citizen Bank may need to rely on the report prepared by SVB themselves or their advisors. All the limitations create uncertainties and potential risks. Now let's picture ourselves in this situation. So the whole idea of the M&A due diligence will start from going out to the clients. We have a team of accountants who will be dealing with the acquisition process, and the law firms are responsible for the structure and legal side. The investment banks who will provide the valuations and pricing. All of those talents are integrated and the activities are connected for companies to provide models, structure from both legal and tax point of view. The due diligence, they are tracking for the agreements and making sure we are correct in hope we will have post-synergy after all. Next, I'll pass it off to Ryan, who will dive into the uniqueness of the SVB deal.
Thank you, Star. Distress M&A occurs when a financially troubled company is acquired by another organization. In this case of First Citizen Bank and Silicon Valley Bank, First Citizen Bank recognized the potential in Silicon Valley Bank's distressed state and strategically positioned itself to acquire the market presence, strengthen its portfolio, and leverage Silicon Valley Bank's assets and expertise in navigating through challenging times. Let's explore what are key points that make the Silicon Valley Bank deal stand out in the market. First, one of the remarkable aspects of the Silicon Valley Bank deal is its ability to expand portfolios and unlock new business opportunities. Second, Silicon Valley Bank deal goes beyond providing financial support. It serves as a gateway to new market. Third, innovation and technology are at the core of the Silicon Valley Bank deal's unique offering. Lastly, another key aspect that sets Silicon Valley Bank deal apart is the access to a diverse and talented pool of professionals. First is creating available scale. As a result of the acquisition, First Citizen Bank soared to become one of the top 15 banks in the United States, a remarkable achievement that demonstrated its commitment to creating available scale. An expanded footprint and enhanced capabilities enabled First Citizen Bank to better serve its customers, offer a broader range of financial products and services, and compete on a larger scale. One of the key highlights of this acquisition is the tangible benefits it brought to the customers of First Citizen Bank. With a broader range of offerings and increased accessibility, customers now have access to a more comprehensive suite of financial solutions tailored to their unique needs. Now, let's talk about second uniqueness and synergy, diversifying the client base. Through this strategic initiative, First Citizen Bank has successfully entered the lucrative West Coast market, establishing a strong presence in innovation-driven economies such as San Francisco, Silicon Valley, and Seattle. This expansion has enabled First Citizen Bank to build relationships with high-growth startups, venture capitalists, and technology companies. The Silicon Valley Bank deal has proven instrumental in diversifying the client base by expanding First Citizen Bank's geographic presence. By entering the West Coast market, First Citizen Bank strategically positioned itself at the heart of some of the most vibrant and dynamic technology ecosystems in the world. By establishing a strong presence in these technology hubs, First Citizen Bank gained direct access to a rich ecosystem of innovative enterprises, disruptive startups, and forward-thinking investors. Let's explore how this integration has resulted in a diversified business mix and enhanced opportunities for First Citizen Bank. The Silicon Valley Bank deal brought together Silicon Valley Bank's commercially focused portfolio and First Citizen Bank's loan portfolio, resulting in a powerful combination that diversifies and strengthens First Citizen Bank's offerings. Silicon Valley Bank's expertise in global fund banking, coupled with First Citizen Bank's established loan portfolio, create a comprehensive and robust suite of financial solutions for clients. First Citizen Bank gained exposure to new sectors, industries, and market segments. This diversification might mitigate risk and positions First Citizen Banks to capture opportunities in emerging sectors, while also enhancing the overall stability and resilience of its business operations. Now I'll hand it over to Greg, and he'll be talking about pricing the deal.
Thank you, Ryan. Banks are complex. They have multiple income streams and market segments. Most income comes from interest, but banks also collect fees and commissions on services like transaction advisory, underwriting, and asset management. Banks also have income from trading securities. Most banks have multiple segments. This is especially true with larger banks. It's not uncommon for banks to offer retail banking, wholesale banking, investment banking, and asset management. We have to also take into account mismatches between assets and liabilities. This arises from short-term deposits used to back long-term loans. We must also consider that banks are highly levered, which leaves them vulnerable to macroeconomic circumstances such as interest rates. Continuing considerations for bank valuations. 4, banks are multi-business entities. Each segment can be viewed as its own business, requiring separate valuation methods. 5, banks often value their securities using mark-to-market accounting, which periodically records asset values at market rate, not cost. This causes their asset value to vary tremendously as they record unrealized profits and losses. Finally, interest is the main source of income for banks. This leaves them open to interest rate risk and business risk. It's also important to note that banks cannot separate financing activities from operating activities, which will be useful in our valuation method. And not all interest-generating activities create value. Value must be measured by the difference between interest received on outstanding loans and returns in financial markets and loans with the same maturity. This is related to spread analysis, which we'll cover later. Now that we have our considerations in place, how do we approach valuation? There are three main approaches to valuation: market, asset, and income. Market approach doesn't work well because banks are so different from one another. The asset approach doesn't work well either with mark-to-market accounting, which leaves the income approach. Typically, the income approach uses the discounted cash flow method for valuation, and cash flows from financing activities are not included. Because banks cannot separate operational and financing activities, we use a modified DCF approach that measures cash flow to equity, equity DCF. With equity discounted cash flow, we must take into consideration economic spread analysis, which measures the difference between the rate on loans and the matched opportunity rate. As always, interest rate and business risk must also be considered. And finally, risk-weighted assets requirements must also be taken into account. Now, a little about how equity DCF works. From a high level, discounted cash flow is the sum of cash flows to equity discounted by their respective cost of equity. We can break down cash flows to equity further into net income minus the change in book value of equity due to retained earnings, and finally include other comprehensive income. The cost of equity is the sum of the risk-free rate and the product of beta and the master or market risk premium. Finally, we'll look at a few special considerations specific to SVB. There are a few special factors related to SVB deal that must be priced in. First Citizens was given a $16.5 billion discount in SVB's assets with no toxic investment securities acquired. Further, First Citizens was granted a loss-sharing agreement with the FDIC that offered a 50-50 split on losses to commercial loans over $5 billion. However, this deal came with strings attached. First Citizens was required to retain SVB employees. They were also required to offer a $500 million appreciation instrument to FDIC. This grants FDIC rights to purchase shares of First Citizens at a fixed exercise price or cash for the difference between the stock price and the exercise price. First Citizens was also required to enter a liquidity facility with FDIC to cover contingent liabilities. Finally, as Ryan has shown, synergies, although present, are somewhat limited in the traditional sense. Now I'll hand it over to Amy, and she will be talking about post-acquisition considerations and solutions.
Thank you, Gregory. It is important to understand the risks that may potentially arise after an acquisition deal happens, and what are the potential solutions to consider to address potential risks, and in this case, post-merger risks. To start, I will go over potential solutions to consider for key risks in M&A. It is important to note that there are different solutions for key risks in M&A, and each solution will be specific to each M&A deal. Generally, the main solutions for key risks in M&A include the following. It includes a risk management framework, conducting comprehensive due diligence, having an integration plan, talent retention and integration, and regulatory compliance. For post-acquisition considerations, the main post-merger risks to take into account for this deal are the cultural differences between Silicon Valley Bank and First Citizens Bank. How well will two different business entities with very different cultures be able to integrate together? Essentially, it is Silicon Valley meets North Carolina, and they are the complete opposites from one another. Silicon Valley is very entrepreneur driven, with many startups that drive the talent and energy within the area. On the other hand, North Carolina is very traditional, with banking being no exception to this. Keeping this in mind, something to consider is the misalignment between Silicon Valley Bank and First Citizens Bank, which will potentially result in culture and operational synergies failing to realize. Taking the post-merger risks into consideration, the solution that would best address the post-merger risks for the deal between SVB and First Citizens Bank would be having an effective integration plan, and in this case, it would be a post-merger integration plan. This is the process of bringing two or more companies together with the aim of maximizing synergies to ensure that the deal lives up to its predicted value. In a post-merger integration, there are 4 phases. The 4 phases include the following. First, it will start with the strategy. Then, it will continue with the transaction and transition phases. And finally, ends with the transformation phase. By adopting a structured approach and utilizing various integration and support streams, the integration process can be carried out effectively and successfully. For yielding maximum results, it is important that the teams involved with the integration are provided with clear guidance in order to achieve the objective of creating value quickly, resulting in a high return on investment and reduced uncertainty. With the deal between Silicon Valley Bank and First Citizens, it will lie between the transition and transformation deal phases. It is currently in the process of transitioning and transforming, bringing both business entities together. I will focus on the last 3 steps of the integration streams and support streams, as it is the most relevant to where the SVB and First Citizens deal is as of right now. Beginning with the integration streams in the section of target operating model and workforce balancing, this is when the organizational structure of a company is affected. The target operating model is an important concept, as this model defines the desired organization with functional teams, an appropriate structure, governance guidelines, essential processes, and a reporting framework. It is imperative to identify key personnel to ensure smooth business continuity. To retain valuable talent throughout the integration and transformation process, it is essential to design and implement talent retention programs at an early stage. Next, it is essential for day one readiness to be planned before a transaction is finalized and signed. The main objective of day one readiness is to guarantee seamless and uninterrupted continuation of daily business operations, ultimately ensuring business continuity. With culture and communication, when an acquisition or takeover occurs, it often involves the convergence of distinctive cultures. In this part of the integration stream, the aim is to establish a shared comprehension of values and actively engage all employees in the cultural transformation. Key factors in this process include transparency, open communication, and regular feedback. To facilitate these elements, it is crucial to develop a communication plan, coordinating with various communication channels. Moving along to the support streams in the section of the Integration Management Office, the office serves as a temporary project management office that facilitates the coordination, alignment, prioritization, and support of integration teams in addressing any challenges that may arise. Additionally, it oversees and monitors the activities of all initiatives and tracks their financial implications. Finally, after the signing of the deal, clean teams can be utilized, granting acquirers access to sensitive data previously off limits due to various restrictions. Leveraging the gathered information, the clean team will be able to provide decision makers with outcomes to strategize the operational processes and organizational structure of the merged company prior to the final closure of the transactions. With post-merger integrations, identifying key factors significantly increases the success rate of an integration process. A crucial element is the presence of a well-defined integration strategy that garners support from all teams involved. Mergers and subsequent post-merger integration activities tend to divert attention away from day-to-day operations for both top management and employees engaged in the clean team and post-merger integration team. Swift completion of the integration allows the company to expedite value realization and refocus on operational tasks. Clearly established synergy goals serve as a vital foundation, necessitating the assignment of responsibilities for their implementation. A strong integration management office assumes the role of a pacemaker by overseeing progress and providing regular updates. It is essential to establish a functional organizational structure that consolidates the merged companies into a unified entity and ensures talent retention. Lastly, a change process must be embraced by all parties with clear and transparent communication serving as a pivotal success factor. Successful integration requires it to be an organized and thorough process. All of these are factors that are pivotal in ensuring the post-merger integration is successful. The deal between SVB and First Citizens Bank is unique, and through this deal, a closer look has been taken when it comes to the stressed acquisition deal. With anything in M&A, no one deal will be the same. All deals in M&A are one of a kind, and what happens in one deal will rarely be replicated again in another deal. We hope you have enjoyed our presentation. Thank you for being here, and we hope you have learned something about opportunities and uncertainty, more specifically corporate salvage in Silicon Valley Bank. Thank you.
Amy, thank you very much for that closing and those closing remarks. All of you, Nancy, Greg, Ryan, Star, Michelle, that was an outstanding presentation on really what is one of the most complex capstones that we've offered in all 3 or 4 years that we've been doing this. You took on a very contemporary issue, which is also going into a period where companies are going to be looking for acquisition of distressed business opportunities. And to be able to help people understand the challenges and opportunities is critically important. So again, compliments to you all. The other thing too is I just want to pay particular note on how I saw so many of you at so many of the outside advisor meetings that we had in the last couple of weeks. Those of you that were on the calls with Greg Lau and Annalisa Barrett, Zach Goodman from E&Y out of their FSO group, that guy that shares the same last name of mine over at Ackerman Law down in Miami, Professor Malloy. All of those conversations really have led to what I thought was an outstanding panel discussion on really one of the hottest issues out there in America today. So again, thank you so much. For those out in the audience, this concludes our webinar. I want to thank those of you who have joined us today and hope everyone enjoyed this fantastic presentation. We will post this webinar for on-demand replay on the Rady's YouTube channel. If you're interested in the presentation materials, don't hesitate to give us a call at Rady and we'll arrange to share those materials with you. On behalf of our students, our faculty, and everyone at the Rady School of Management, we thank you for joining us today and look forward to seeing you again and hopefully in the very near future. Bye now.